Capital is currently moving at a velocity we rarely see. Trillion-dollar market caps have become the new baseline for performance. The momentum suggests a permanent shift in how we value growth in the technology sector. But pull the timeline back 25 years to early 2000, and the parallels are exact. You will find the same vertical charts, the same media promises, and eventually, the largest destruction of wealth in modern history. The tension lies in the gap between the functional software being deployed today and the volatile financial ecosystem that has grown around it. Distinguishing the two requires moving past the sentiment of the trading floor and into the specific economic metrics. This chart maps NVIDIA's trajectory from 2022 to early 2026, marking a 1,300% surge to a $4.3 trillion valuation. Below this, private capital moves in lockstep. Venture funds poured $258.7 billion into AI in 2025, capturing 61% of global venture funding. Traders and institutions are calculating the risk of standing still. The fear of missing out on a commercial rollout comparable to the birth of the internet is driving billions of dollars in daily volume. When the numbers reach this scale, skepticism gets expensive. The sheer weight of that capital makes the claim that things are different this time very difficult to ignore. We have seen this specific market psychology before. On March 10, 2000, the NASDAQ Composite closed at 5,048, and the trading floors were celebratory. Then, the math caught up to the momentum. The Federal Reserve raised interest rates, and financial reports began noting that newly minted hairnet companies were burning through their cash reserves without generating sustainable revenue. Startups with massive backing folded almost instantly. Pets.com, despite heavy funding from Amazon and high-profile advertising, went out of business just 9 months after its IPO. The sell-off was absolute. The NASDAQ plunged to 1,139, and in a matter of months, $1.75 trillion in value evaporated. The internet eventually integrated into almost every facet of global commerce, but for the people who bought at the peak, that success was irrelevant. A functional technology does not always justify a speculative price. Look at the current market, and the same warning lights are flashing: stretched valuations and aggressive future pricing. In 1996, Federal Reserve Chairman Alan Greenspan described irrational exuberance, an unsustainable investor enthusiasm that inflates asset prices far beyond their actual worth. The institutional anxiety is measurable today. Surveys indicate that If you measure the market purely by the velocity of capital and the anxiety of traders, today looks like a reflection of the year 2000. But market psychology is only half the equation. When we look at the actual server racks and the enterprise ledgers, the comparison begins to shift. During the dot-com run, telecom companies spent over $500 billion laying 80 million miles of fiber optic cable. By 2002, up to 90% of it sat dark, waiting for customer demand that hadn't arrived. Today's infrastructure build-out has the opposite problem. Cloud providers like AWS and Azure report that their new AI computing capacity is fully utilized the moment it comes online. That physical demand translates into immediate cash flow. NVIDIA recently reported fiscal year revenue of $215.9 billion, operating with a 75% gross margin. This McKinsey analysis shows how generative AI is already embedded in 88% of enterprise organizations, driving productivity gains across marketing, engineering, and research. The companies of 1999 were selling digital brochures. Today's infrastructure companies are generating billions in revenue from a product that is already in production. However, high revenue does not grant immunity from gravity. When a stock is priced in the trillions, the market expects total, unbroken perfection. And perfection is fragile. In early 2025, that fragility was tested when a startup called DeepSeek released a competitive AI model. They trained the model at a tiny fraction of the standard cost. This challenged the assumption that AI progress requires an ever-growing mountain of expensive hardware. The market reaction was immediate and punishing. NVIDIA lost $588.8 billion in market value in a single trading session. The technology is functional, but these valuations remain sensitive to any shift in software efficiency that could undercut the need for massive hardware orders. Because of this vulnerability, the consensus view among analysts is not pointing toward a systemic collapse, but a selective correction. The massive cash reserves and immediate utility of these systems provide an economic floor that the year 2000 lacked. The largest firms have the profits to justify a large portion of their weight. AI has already proven its utility in enterprise environments. The challenge for investors isn't whether the technology works, but whether the market can deliver returns as fast as they have been priced in.